Hi, I'm Mike Caldwell. I'm the Director of the Business Innovation Zone. The Business Innovation Zone, or the BIZ, was created to help high-growth potential entrepreneurs and businesses in central Iowa. We provide a variety of services, including mentoring, consulting, counseling, validating business models, and help with access to funding for high-growth companies. We offer also a number of networking opportunities, including luncheons once a month and all-day seminars on subjects such as marketing and finance. You can find out more about the BIZ at www.bizci.org.
Well, it's good to see there's people with business ideas want to get it kicked off, which is always exciting and scary and challenging, and there's people here with existing businesses that want to expand and move into different areas. So that's always a neat thing to see. At LWBJ, we've been around since 1991. We're a CPA firm, financial consulting, business advisory, and investment banking firm. I work on the consulting, advisory, and the banking side. We call it LWBJ Capital Advisors. We help businesses anywhere from the startup phase to, divisions of publicly traded companies that want to sell. So in the startup phase, we work with Mike and various organizations and others to once the company has the business plan put together, to introduce them to high wealth individuals or other people who want to invest. And that's what we've been successful at over the years is that process. We also help businesses with valuations, which is always a challenging, I'm going to speak about that later today, turnarounds and selling the business. So we've seen a lot over the years. It's been an interesting process. In the late 90s, there's a lot of capital. A lot of businesses got started. And that dried up when the internet bubble crashed in early 2000. It became a lot more difficult to raise capital. And the last couple of years has been really difficult with the financial crisis and everything that's been going on. It's been a real challenge. But there is money out there, and there is opportunities out there. And we're going to talk about those today, I guess. Before we dig into this, it's probably good, and this may be a refresher or maybe below some of you, but just to talk about the two types of basic capital. There's debt and equity. Debt, obviously, it's a legal obligation to pay it back. You got to pay it back over time, at some point in time. Equity, permanent. It's always there. It's something that you get an investment and you don't have to pay it back. So and there's different levels of debt. There's different levels of equity, but that's the basic concept involved. So when you're looking at your business, the first thing you need to do is say, what kind of capital do I want? When do you go out to have debt? Well, obviously the biggest thing is when you can pay it back. You have to be able to pay back debt, so you have to have a cash flow. You have to have money coming back in to pay back debt. So if you don't have a cash flow, obviously you got to look at equity. But then the next question is, if you do have a cash flow, do you automatically say, do I want to have debt or do I want to have equity? Well, it depends. With debt, you don't give up any ownership. But if you give up equity, you give up ownership, so you have another owner. So that's a big step in a company's life when you bring on an equity partner, because it really is another owner, and there's different levels of interest that equity partner will have in your company. Some people just say, hey, and this is more the friends and family that Mike was talking about. Here's $100,000. Go knock yourself out. And for a lot of startups, that's the best kind of money to have because you can run and go and make it happen. But for some startups, it's probably not the best kind of money because other investors want to get involved, and a lot of the people we work with want to get involved and want to have an active role. These people may be ex-successful entrepreneurs, ex-successful business people. They'll give you the $100,000. They say, well, I'd like to be involved on a monthly, weekly, daily, hourly basis. And if that's the case, that's a big change for an entrepreneur, for a business person to get involved with, is having that level of interaction with a investor involved in the company. Sometimes it works, sometimes it doesn't. And when we get involved with a company, I guess that's one of the main things we really try to understand is this potential investor a passive investor, or is he going to be an active investor? And if he's an active investor, are the talents this person bringing going to help the business owner? Again, can the business owner, is he the type of person that can deal with that type of an investor? So it's always a challenge. So getting back, if you do cash flowing, And you may still want to have equity, but it depends upon what you're going to do with that cash. If you can take that capital and create a lot of value by not paying it back, keep it in the business and create all kinds of value, it makes sense to take it as equity. Because the money's there, you have a partner you can live with, and you're using that capital to create all kinds of value in your business. So again, that's the first thing we kind of sit down and look at when we're dealing with a capital raise is what makes the most sense, and either it's debt or equity. If you look at the debt side, there's different kinds of debt. There's, I think all of us are familiar with senior debt, secured debt. You go to the bank, sign the agreements. They have first interest in all your assets, so if you don't pay it back, they'll foreclose on your assets. A lot of times, in a startup or early stage company, you have to have a personal guarantee, which is a big decision to make as a business owner, because if you can't pay it back, then they can come after your personal assets. And I don't think a lot of people really understand that when they're getting into a business, that when you sign that personal guarantee, it's a big thing. There's covenants that you have to operate to, financial covenants, there's operating covenants. So senior secured debt is an option. You have to be able to pay it back, but there's risks with it and that type of thing. There's for businesses that are starting out and for others, there's some great government programs out there. In the ag side, there's the USDA program that will guarantee, that will make it a lot easier to get a bank debt. They'll guarantee the bank portion of the debt. So if you don't pay it back, the USDA will pay the bank. So the banks are much more apt to loan a company that really isn't bankable because the USDA will guarantee it. And then there's the SBA. The SBA, and Obama's, I think, has done a great job of this, is making funds available through an SBA program. They've raised billions of dollars over the last couple of years that they could use to guarantee bank debt, and it kept businesses going, and it had helped new businesses get started, and it was just a really good deal. That money was all used up at the end of last year, and what they would do is guarantee 90% of the bank loan. And it was, banks were having trouble loaning money, but with that type of a deal, they were able to loan a lot more money to businesses like you're all trying to start or you're all working on. But the SBA is still out there. Now, rather than guaranteeing 90%, they guarantee 50%. So that's a good program. So there's bank debt. Another big thing that people ought to think about too, if your business is up and growing and you need some capital to expand or whatever, look at leasing. Leasing companies, if you need some equipment, if you need a piece of equipment, if you need, something like that, a leasing company will be a good source for that. That they don't have to, they look at the company, but they're more concerned about, okay, here's the asset, here's the payment terms, and if you don't pay me back, I can just take that asset and sell it. So is it sellable? So that's something to keep an eye on too, depending upon what you need the financing for. So that's senior debt if you go to the bank, and there's subordinated debt. So what this is maybe the company, your company already has a senior, banking relationship in, but you need some more money somehow, and you have enough cash flow to pay it back. So what you do is you go to an investor, you go to somebody else and say, hey, I'd like to borrow some money. I already have the banks here, and I'm no problem paying the bank back, but I need a little bit more money. So what they'll do is they'll loan you money, and they'll be subordinate. They'll be a lower position as a creditor to the bank. And I guess we're seeing a lot more of that too, in that investors are a little bit more skeptical in this day and age, and they want a little bit more protection. So what we've been able to structure is subordinated type debt. And then once the company hits certain performance, or you're able to hit certain benchmarks, you convert that debt into equity. So it's just another layer of protection for the investor, and it gets the business owner. What you want is capital to grow your business. So that's really the debt side. If you look at the debt, there's a line of credit. So if you need money just to grow the business, and you have receivables and you have inventory, you can go to the bank and get what's called a line of credit, and you just borrow against your receivables and inventory, and then you pay that back when you collect it into cash. If you need a longer-term assets, then it's a term type of a loan. So you structure the loan based upon what's there. I don't think there's any minimum size. We work with, I guess the startups we work with, we try to we try right away to get a banking relationship set up, because I think it's probably a good thing. And even if it's a $25,000 line of credit or whatever, it's a good thing to get a credit rating going and get that going. So I don't think there's any type of a minimum, but you do need collateral. You do need receivables. You do need inventory, or you do need a good personal balance sheet that you can personally guarantee. And that's even become more difficult. If you don't have the collateral, even if you do have a pretty good balance sheet, a lot of times banks are reluctant to loan nowadays on the personal guarantee. So the key is to get past the startup phase and to get to a point where you have some collateral you can borrow against. The equity side, against permanent capital. So you got this person that you got to deal with somehow, whether hourly or yearly or however the case may be, and it's permanent capital. So you have it. It's your responsibility to use it prudently and to use it as according to your business plan to grow your business and create value. The basic type of equity is common stock. It's the basic level of equity investment. It's all you really have is ownership in the company, and you share in the profits after you pay off your debt and those types of things. You share based upon your ownership percentage. But there's different things you can do with equity. So you typically, the founder of a business or the starter of a business has common stock. But if you bring in an investor, the investor may want to say, well, I'm putting in capital. I want a little bit more of a preference over you. So what you can do is issue preferred stock. So the preferred stock sits above the common stock and has rights to the assets before the common stockholders. So you can bifurcate your equity ownership somehow based upon the type of the stock. So those are I guess as kind of an overview as we get through this, are the different types of capital that you should be taking a look at when you're looking at your business. Any questions? Comments? So as you go through this, the idea phase, the self-funded, how do you get this thing going? And in today's environment especially, I hate going back to the late 90s, but it was great. You could have a business plan, and this really did happen. You could write your business plan on a napkin and talk to somebody. You can get the thing funded. It was crazy. It was just a crazy time. But it doesn't work that way anymore. It's the idea phase is you got to be creative, and a lot of times put up your own money in this thing and make your own sacrifices, not take a salary. And what we're dealing with a company right now is that we had an interesting meeting yesterday. We introduced them to 3 or 4 ex successful executives, and they were sitting there making the pitch. And this company was, and they just need $50,000 more. They raised $500,000, need $50,000 more to break escrow. And the founder put in $50,000 money. He hasn't taken a salary for a year, and he put $50,000 of money into the company. The other investors put in $100,000, and so we're trying to figure out how we get $50,000 more. And so the investors go, well, why don't you put to the founder? Why don't you put $50,000 more in? We all put $100,000. You only put $50,000. And he goes, well, I didn't take a salary for there. They said, well, tough. It's you got to. You have to when you're going to present yourself as a potential investment to a company. Be ready for things like that. Is that you may take the sacrifice of not getting paid, but those are the types of things the investors are going to take a look at. Is, well, I put $100,000 in. You ought to put $100,000 in. So I think the thing to remember is, be prepared that if you're asking an investor for something, you better be prepared to be able to do it yourself. And I think that was an eye opener for this person yesterday. So the first round of the first type of money you raise for your business is your capital, and your capital is hard dollars that you put in. Your capital is not taking a salary. Your capital is bootstrapping the business. Your capital is contributing personal assets, whether it be computers or in technology companies, a lot of the time what you contribute is your invention, your patents, your software you've developed, your other things that are out there. So I think that's a real good selling point, that when you write your plan and when you go out for capital is really truly define what your capital is that you put into this thing. And the more capital you've put in, the easier you can the easier it is to raise money, the easier it is to get a higher valuation, the easier it is to do all the things that are good for you and in your business. But it's a very important thing. You know, no, not anymore can you go out and say, I'm not putting anything in, I want you to put $1 million in my business, I'm going to take a $200,000 salary. That doesn't work anymore. That's the first, and that's the foundation of your business. If you're going to go out, if you need outside money to grow your business, your capital is a very, very important thing to start off with. So then you get past the idea phase and you're in the proof of concept phase, and again, self-funded is your capital. Friends and family, you know, that's probably the best capital you can get at this phase, assuming you can go to Thanksgiving and see everybody and talk to them. You know, you have to be able to, you know, if it doesn't work out, you got to be able to deal with those people. And you've seen a lot of that where it's not very pleasant going to the holidays anymore, where you've spent the money if they're not, you know, if they're expecting to get paid back. So that's always a tough one. You know, the proof of concept phase is, if you can, the farther you can get through the proof of concept phase without getting outside money from, you know, keep the friends and family and you together, the better off you're going to be. But if you do need to talk to if you do have a good idea and a good concept, it's a good market, you know, everything's teed up, and you want to go out to angel investors, there are angel investors that want to get involved. The ones that we see that get involved in this phase are people that have been successful in the past, that want to get back after it, you know, kind of like a Brad that wants to get back after things, put their money into it, and be actively involved. And there's nothing wrong with that if that's what you want out of your business. So those are I guess the equity type things in the proof of concept phase. The SBA, the USDA, government-backed programs are also big too. But with those, they'll want personal guarantees. You know, they'll want to. You know, and what they're doing with personal guarantees now, they'll also have you pledge whatever real estate you own, which includes your house. You know, so if you don't pay it back, you know, those are the things that are on the line there. The state of Iowa, there were demonstration type funds where you were able to get some money. There were entrepreneur type funds that were able to get some money. And I know Mike helps a lot of companies get those types of funding. But it's, you know, it's in the paper today. It's changing. So at this. You know, so a lot of times you sit back at this phase and people are going, oh, geez, you know, I'm having trouble getting this thing going. You know, we can't get any investors. You know, maybe I don't want to put my house up right now. But so what a lot of companies have done the last couple of years is found, you know, have gotten the product to where it's working and found the first big customer, kind of the Walmart kind of concept, and said, hey, if you help me fund this thing, if you fund this thing and help me grow it and pay me maybe something up in advance, help me develop you know, I can use the money to develop the product, get it going. We'll give you preferred pricing. We'll give you royalties. We'll give you exclusivity in a certain market. This is where we've seen a lot of people being creative and using potential customers or using customers to fund the startup of their business and get it to a point where they have something that's working and something that they can demonstrate that then they can go out and get investment. So I think the key, if you're going down the equity route of bringing in a equity partner, I think you got to be creative. I think you got to look at all the different options that are out there and be resilient. Is probably the biggest thing. So you get past the proof of concept, it works. You know, and probably a great example here is a company up in Ames called Web Filings, who we've worked with a little bit. And this is probably a great startup type company for Iowa. A good example of how it works in these phases of getting to these types of investors. But they're ex-successful entrepreneurs, companies. They sold their company 15 years ago, made a bunch of money. They came back and started a new software company, put $5 million of their own money in. And it can be $5 million, it can be $100,000, it can be $50, but whatever. They needed that much money to develop their product. They found 4 beta sites where they were able to get their product in, and these companies actually use them and prove the concept out. After that happened, they were able to set their valuation at a high enough level and bring in angel investors, brought in the state of Iowa. They have seed funds that are interested, and they have regional venture capital firms knocking at their door. But what they were able to do is take the idea and the proof of concept and get it to a point that showed that it works, that it had competitive advantages in the marketplace, that the marketplace was big, huge, that people could make a big return. They set their valuation at a level that was certain high. And by setting that value, that's an important thing because you don't want to give up a lot of ownership when you raise money. So the earlier in your business life cycle you raise money, the lower your valuation, the more ownership you have to give up. So they were smart enough to do it later, gave up less ownership, maintained control of the company, and were able to attract all these different types of folks. So, it's difficult. It's difficult to get the regional VC firms interested in a company unless you get it to a certain size and the market's big enough. So that company was able to do it. Yep. So they're probably a recent company in Iowa that started out here, kind of went through the proof of concept, got some ideas, and were able to get to a point where they have a big market and attracted all these groups. And the state of Iowa, I think, gave them $2 million, which is all public info, and they're off and running and doing some good stuff. So, it does work. It took them 5 years to get to this point, but they put in their own money. They did bring in their capital was well defined. What they put in, they did have friends and family they brought into the thing. So they kind of went down the whole route we just talked about, and got to a point that works. The expansion phase. Again, this is where you're really, you're positive cash flow. You're growing leaps and bounds, and you need capital to get to the next level. And that's where that's where Mark's companies get involved. The investment banking firms. That's what Iowa's put money in these companies to have capital. And these companies are actively looking at Iowa companies to see if they're at a certain phase, if the market opportunity is big, and if they're good investments, and so I think the state's done a good job of teeing up capital once you get to this phase. Yeah, venture capital I think is more of the smaller, earlier stage companies. Maybe the company doesn't have a full management team in place yet. Maybe they don't have a full sales team in place yet. Maybe they're not cash flow positive yet. But the potential's there, and this venture capital firm invests in these earlier stage companies. They have expertise and they can add value with their investment, and by doing that they can get a bigger return.
Typically be willing to take more risk than?
Yeah. I think an investment banking firm, well, they'll get involved with the company is more mature, has maybe the management team in place, has proven itself, and needs the capital to grow into a new market, to continue to grow, or whatever the case may be. So it's just a later stage. They look at later stage. And then growth stage, all the above, plus commercial banks. And I think, banks, I guess we encourage, even startups to get involved with the bank just to develop that relationship. But I think throughout the whole process, I think you ought to take a look at banking relationships. We did talk about equity capital a little bit in the beginning, but it is ownership. It is permanent capital. You don't pay it back. I can't stress it enough. When you bring in, people may want to give you money, but you need to take a look at it and say whether you can live with this person, through this process, because it is. We've seen situations that haven't worked out, and it's not good.
And it's really expensive to buy them out later.
It's really expensive to buy them out later. Yeah. So it's a big decision. They're involved. You have to really. You can be kind of loose with your business before you have equity capital. If you have debt, you have to pay it back, obviously. But once you have another owner, you have some fiduciary responsibilities to take care of the business, to run the business, to have board meetings, things like that. But we've seen situations, and it's. I tell you, I've lived this last 2 years working with a company that didn't have a buy-sell agreement, and the owner's got in a dispute. It's not pretty. Now, I firsthand would recommend the first thing you do is get a buy-sell agreement in place. And then, later we'll talk about valuation, but dilution's a big thing. So when you bring in equity, you got to figure out what your business is worth, and obviously you want it at as high as possible. The investor wants it as low as possible, so there's negotiation that happens. But you do give up ownership. You give up control. And the big thing, a lot of business owners get really concerned about, am I giving up control? Am I giving up 50%? Am I going to be below 50%? And it's a big thing to keep in mind when you're giving up equity.